Just a few hours ago, we got huge news that the US has struck three of Iran's nuclear sites. And as a result of this, we are probably going to be seeing huge tension between the US and Iran and potentially see greater war actions, which means that these general aerospace and defensive stocks could see huge moves in the coming weeks. And I'm going to determine if we should be buying these stocks. I'm going to be analyzing four aerospace and defense stocks, starting with Lockheed Martin, then General Dynamics, then Northrop Grumman, and finally RTX Technologies. As we can see here with the Aerospace and Defense ETF made by Spider, we can see that this is up over 20%, which holds the biggest aerospace and defense companies. And as a result of this is up because of the huge conflict in Israel and Iran, and whether or not US will get involved with this conflict and potentially go to war. So what does this mean for aerospace and defense stocks? This has given a nice boost in the stock prices of these companies because of increased worries of going to war, and which these companies will get huge contracts in order to fulfill the orders and demands when we go to war, if this does happen. And they will, even if we do not go to war, they will still have huge contracts to probably still supply Israel with these defense products. The United States is currently sending a variety of weapons to Israel, and as we can see here, the main products are air defense systems, which is basically what is called THAAD, or Terminal High Altitude Area Defense, and this is supporting Israel's defense systems. Also, we have precision guided munitions, artillery shells, bombs, and other military equipment. But the main ones is air defense systems, which is THAAD. And who has the most THAAD contracts? And this will be Lockheed Martin, and they have been a major role in the US government with these THAAD systems since 1987. So the first company we're going to be looking at is Lockheed Martin. And as we can see here, their main products are military aircraft like the F-35, which most people know, and the F-16 Fighting Falcon, and helicopters like Black Hawk. So if we go ahead and look at Lockheed Martin's revenue breakdown, we can see over almost 41% of their revenue comes from just their aeronautics, which is the most out of any other company we're going to be analyzing today. Also, 24% in rotary and mission systems, 18% in space, and 16% in missiles and fire control. With this being said, Lockheed Martin looks like in a pretty good position, especially if we're going to be continuing sending these THAAD systems over to Israel and potentially going to war against Iran. So the first thing that I'm going to look at is the trailing PE ratio of Lockheed Martin, which shows us the valuation of the company, where it's the price divided by the earnings. And as we can see here, they are trading at about a 20 PE ratio, which is about in line with the total stock market. So it looks like it's trading at a fairly valued price if we compare it to the stock market. Now I'm going to take a look at Lockheed Martin's revenue growth rate, and I want this to be growing at a pretty good rate. I want this to be at least increasing over time. And as we can see, in 2010, they had about $44 billion in revenue. And as of 2025, they've had $72 billion in revenue. So they are growing their revenue. While it's not very fast, it's at about a 5% rate. So it's not terrible, but also not as fast as I would like it. But now we're going to go ahead and take a look at the net income of Lockheed Martin. Similar with the revenue, I want this to be increasing over time. As we can see, in 2010, they had $2.93 billion in income. And as of today, they have $5.5 billion in net income. So over 15 years, they have doubled their net income. That still isn't very fast growth, but in the aerospace and defense, this is not going to be a huge growing, fast growing business unless it's a very small company. And Lockheed Martin is one of the biggest companies in this industry, so this slow growth doesn't surprise me, but at least it is growing over time, so that is a good thing. Now, if we take a look at shares outstanding, and this is actually a pretty important metric that I like to look at, that some people might not actually know about. And I want this to be decreasing over time, or have these companies using buybacks. Because if companies buy back shares, that means us investors will have more of the company. Since there's going to be less shares outstanding, that means our shares will become more valuable even if we had the same amount of shares, since we'll own a bigger percentage of the company. And as we can see, Lockheed Martin has been buying back shares insanely. Look at this large decrease in shares outstanding. It's been decreasing at about 4 to 5% over the past 15 years. So that looks very good for Lockheed Martin. And this is going to give us a better return over time because they are actually giving us a more valuable share. Next, I'm going to look at the total debt divided by equity ratio. I want this to be less than 50%, meaning that they have more than double the amount of equity compared to their debt. However, if we look at Lockheed Martin, their debt situation doesn't look very good at all. They actually have a 300% total debt to equity ratio. That means they have 3 times the amount of debt when compared to their equity. And as we can see here, they don't even have $2 billion in cash. But if we look at their total debt, they have almost $21 billion in debt at about $20.3 billion. So if they paid off all their debt with the cash they have, they'd have about 18 billion still left in debt. So this debt situation has me very worried about Lockheed Martin. Could potentially show signs that they could possibly be in trouble if their income and revenue start to decline and the US government stops supporting them as much. This could be some big trouble for Lockheed Martin. Finally, I'm going to take a look at Lockheed Martin's analyst expectations for their earnings per share growth over the next 5 years. I want this to be greater than 5% because I want to see that in the future that they're expected to grow at a decent rate, which if a company will grow at a certain rate, our return will likely reflect that rate of growth, especially if we pay the right price for the company. And as we can see here, they're expected to grow at about a 10.5% rate over the next 5 years, which is year over year. So that's a pretty good growth rate that right there that analysts are expecting. So if that comes true, this would be good for the company. But I do worry about the amount of debt that they have. It's very high. Now for Lockheed Martin, I'm going to be using this intrinsic value calculator to determine the price that I'd be willing to pay for this stock. So the first thing I have to put is the revenue growth rate that is expected from Lockheed Martin. And as we can see, they've averaged about a 10 over the past 10 years, they've averaged about a 5% revenue growth rate each year. So while the Lockheed Martin that analysts expected them to grow at about a 10% rate, this is their revenue growth rate. So I'm thinking anywhere from 3 to 6%. Let's go right in. I would say actually 5% is pretty reasonable for Lockheed Martin. Because analysts expected them to grow at about a 10% rate, but over the past 5 years, they've been slowly growing. I think right here is pretty good, reasonable place to be. And I would like to be less than what analysts expect because we want to be conservative in our assumptions. Next, the net profit margin. I'm going to put the net profit margin at 9%. Just because if we look at how consistent their net profit margin has been, we can see that this is a fairly reasonable net profit margin. And the cash conversion rate, leaving at 100% seems pretty reasonable. Terminal PE ratio, I think a 20 PE ratio is also pretty reasonable since they're trading at about what the stock market is. While their revenue growth rate might be slightly lower of the stock market, I do think that they deserve a slight premium just because of the name of the company and the contracts that they have from the US government. Now, if I put a discount rate of 15% to ensure a margin of safety, we can see I have a fair value price for Lockheed Martin at $393 per share. I think if you bought this stock today at $470, you could probably make about a 12% return each year. So you would slightly beat the stock market by about 2% with these assumptions if you truly believe these assumptions are true. But if I put the terminal PE ratio at 18, which seems a little more reasonable just because the revenue growth rate's so slow, we can see this will bring our returns down slightly at about 11.5% return and a fair value price of $370. So I would think if Lockheed Martin got to about $350 or $375 in that range, I would start adding to this position. But I am very worried about the total debt that they have. So you might want to factor in that into this fair value price since this calculator does not factor in the debt. So I would be slightly worried about that. but Lockheed Martin does have a bit advantage over these other companies, especially in the Israel and Iran war. Now, the next company that I'm going to be looking at is General Dynamics. And as we can see here, General Dynamics F-16 Fighting Falcon is actually the most widely used fighter jet in the entire world. In General Dynamics, as we can see, they are focused on business jets, combat vehicles, submarines, and communication systems. These are their main products that they have. And if we go to the revenue breakdown, they have a pretty equal amount of revenue in each segment of their businesses. As we can see, it's around 20 to 30% for each business in aerospace, combat systems, technologies, and marine systems. If you think in the Israel and Iran war, they're going to be using more aerospace and THAAD systems, it looks like Lockheed Martin would have the advantage here just because that they are concentrated more than General Dynamics. So with that being said, I think Lockheed Martin would be in a better position just because their revenue is geared more towards the aerospace segment, especially compared to General Dynamics. If we go over the similar metrics that we did for Lockheed Martin, the first thing we're going to look at is the trailing PE ratio. And as we can see, General Dynamics has a slightly lower PE ratio of about 19. So it is just one less. However, it does show that they're slightly lower valued compared to Lockheed Martin. But this does not mean that General Dynamics is automatically a better buy compared to Lockheed Martin. And if we look at the revenue growth rate of General Dynamics, we can see in 2010 they had about $31 billion in revenue, but as of now they have $49 billion in revenue. So if we compare this to Lockheed Martin, I'm pretty sure that General Dynamics is a slightly slower growth company. However, if we compare them in the past 5 years, it seems that General Dynamics has seen a much greater increase in their revenue when compared to Lockheed Martin. So I have no clue what the reason for this is, but as we can see, over the past 2 years, they've increased their revenue by 10% almost each year. So it seems that in the past few years, General Dynamics is starting to grow faster than Lockheed Martin. But once again, I don't know the exact reason for that, so you guys would have to do your own research. But with the net income, we can see in 2010 they had 2.4 billion, and as of today, not even 4 billion. So if we compare that to Lockheed Martin, they had about the same net income in 2010, but as of today, Lockheed Martin has about $5 billion in net income, while General Dynamics only has 4 billion. So the growth in General Dynamics does seem slightly slower than Lockheed Martin, which is probably why their PE ratio is slightly lower. Similar to Lockheed Martin with the shares outstanding, we can see they're buying back shares at a pretty fast rate. Very similar to Lockheed Martin, and I really like that they're doing this, especially because they're probably getting a greater return on this than, say, reinvesting back into their business. Normally, companies that are slower growth will start to buy back shares since they can't really invest in the business to get a greater return. So this looks pretty good also for us shareholders. Now, if we go ahead and take a look at General Dynamics total debt to equity ratio, once again, I said I want this less than 50%, and it's at 51.78%. And this is much less than Lockheed Martin's 300%. While it's not less than 50%, this shows a much better balance sheet when compared to Lockheed Martin. But once again, they only have $1 billion in cash and $11.5 billion in total debt. So they must have a lot more equity when compared to Lockheed Martin compared to their cash. So this means that Lockheed Martin is slightly worse scenario compared to General Dynamics. But once again, I think this industry tends to have a lot of debt when compared to other industries in the business world. Finally, if we take a look at General Dynamics earnings per share expected by analysts, we can see that they're expecting about a 10% increase in the next 5 years for each year. So this is almost the exact same compared to Lockheed Martin. So these companies look very similar. However, Lockheed Martin has a very slightly better increase in their growth rate, while Lockheed Martin also has a worse balance sheet in which they have a lot more debt compared to their equity. Now, if we look at the intrinsic value for General Dynamics, once again, I have to put the revenue assumptions for the next 10 years. And as we can see, compared to Lockheed Martin, actually in the past few years, General Dynamics has been growing faster, like I said. But over the past 10 to 15 years, Lockheed Martin has actually been growing faster than General Dynamics. So when analysts expect us to grow at about 10% for General Dynamics, for their earnings, which is not factoring the revenue in just their earnings, I do believe that General Dynamics might grow slightly faster in the future at about 6%. And with the net profit margin very similar to Lockheed Martin, I think that their net profit margin will put it at 9%, very similar to Lockheed Martin. With the terminal PE ratio, I think that they actually also deserve a 20 PE ratio just because their revenue growth is at about 6%, and it's slightly lower than the total stock market. But once again, the US government will back this company, and they do have a competitive advantage, having the biggest fighter jet in the entire world being sold that they create. So, with the discount rate of 15%, I have a fair value price for General Dynamics at $250 per share with these assumptions. And as we can see here, if you bought this today, I think you could return about a 13% year over year return on this company if you bought this today. So compared to Lockheed Martin, I actually think General Dynamics might be slightly better. The only reason I say that is because of their balance sheet and their total debt to equity ratio. But once again, they still have a lot of debt when compared to the amount of cash. They have about a proportional amount of debt when compared to Lockheed Martin with their cash. So this does not look good for these two companies so far. But if we take a look at the next company at Northrop Grumman, and if we take a look at what they basically sell, and they're the leading US provider of solid rocket propulsions for national security and defense. And if we can look at who makes stealth bombers, which has been being heavily used in Israel also, we can see Northrop Grumman is the biggest company that manufactures these stealth bombers. And if we're going to go and do the same thing with Northrop Grumman, let's take a look at the trailing PE ratio. And as we can see with basically all of these companies, they're trading at a very similar PE ratio of 19 to 20. So this is very consistent in this industry as we can see. So they're trading at a 19.6 PE ratio, which is slightly higher than General Dynamics, but slightly lower than Lockheed Martin. But it is such a small amount that it doesn't even really matter. If we take a look at Northrop Grumman's revenue growth, we can see in 2010 they had about $26 billion in revenue, and right now they have about $40 billion in revenue. So if we compare this to Lockheed Martin and General Dynamics, it's very similar. And actually, Lockheed Martin so far has had the most revenue, but this is very similar to General Dynamics revenue growth. And as we can see, they've had declining revenue all the way from 2010 to 2016, but since 2016, they've seen huge growth in their revenue. So this looks pretty good in the past 10 years for Northrop Grumman, but if we forget about those first 5 years on this chart, it looks very good with their growth rate. Now, with the net income for Northrop Grumman, we can see that they started 2010 with about $2 billion in net income. And as of today, they've had about $3.7 billion in net income. But we can see all the way from 2010 to basically 2020, there was literally zero growth in their net income. So far, Northrop Grumman looks slightly worse than both General Dynamics and Lockheed Martin to me with this net income growth. And it's been very stagnant and also slightly inconsistent in the past few years. So this looks slightly worse just because we like to see consistency in the stock market and in businesses, just because we can also be more consistent in our assumptions in the future and be more likely to be correct with our assumptions. So this slightly worries me, but once again, all these companies are very slow growing and they've been at about the same amount of net income, and this is almost the exact same as General Dynamics, where they started at 2 billion and as of today almost at 4 billion. So it's pretty much the same. And once again, with the shares outstanding, all these companies are buying back shares. But as we can see in the 2010s all the way to 2017, Northrop Grumman was really buying back shares heavily. So that's very good. But they have started to slow down slightly and decreasing shares at about 3%. So they are starting to slowly decrease the rate that they're buying back their shares. But nonetheless, they're still buying back these shares. But I think Lockheed Martin and General Dynamics have been buying back shares slightly faster than Northrop Grumman. Now, if we take a look at the total debt to equity for Northrop Grumman, we can see they're at 121%. So this is much higher than the 50% we want. And while this is less than Lockheed Martin, this is a lot higher than General Dynamics. And as we can see, though, with General Dynamics and all these companies, they have about the same total cash and total debt. But actually, we can see that Northrop Grumman has a lot more debt compared to their cash compared to both companies. If we looked at the ratio, this would show that Northrop Grumman would actually have the most debt when compared to the amount of cash that they have. So this does not look very good for Northrop Grumman, especially with the stagnant growth rate that they have. So far, this to me looks the worst compared to the first two companies. And if we look at the next 5 years that analysts expect, we can see a huge divergence when compared to Lockheed Martin and General Dynamics, where they're expecting Northrop Grumman to only grow at 3% over the next 5 years. I do not think this is a very accurate representation. However, if we look at the net income, it was pretty stagnant for almost the entire 15 years in the past. So this actually could be pretty accurate in that sense. But do I really think that they're going to grow that slow? I don't think so, but you never know. Analysts do expect them to grow at only 3%. So that is very bad when compared to the other two companies we just analyzed. So now with Northrop Grumman, we can see that we're going to also do the intrinsic value calculator to see what price I'd be willing to pay for this company. And with the revenue growth rate, we can see in the past year, they actually went down 7%. But in the past 10 years, they've averaged a 6% revenue growth rate. So this leads me to believing I think that they can grow at about a 4% rate. I think that they can grow at a 4% rate, especially with analysts expecting only 3%. I think that's pretty reasonable. And now with the net profit margin, very similar to all these other aerospace companies, this company, Northrop Grumman, actually has a higher net profit margin when compared to these other companies at a very slightly higher net profit margin at 10%. So with that being said, now I'm going to look at the terminal PE ratio. I do think that they deserve a slightly lower PE ratio compared to the market, especially with their balance sheet, which is worse than both Lockheed Martin and General Dynamics. While Lockheed Martin's total debt to equity ratio is higher, this company has a lot more debt when compared to the amount of cash. So, and also with their slower growth rate, I do think that this company deserves about a terminal PE ratio of 18. Now with the discount rate, I'm going to put a 15% discount rate for Northrop Grumman. And with this fair value price that I actually have a fair value price of $350 for Northrop Grumman. And as we can see, the forecasted return is about 10% each year if you bought this today and you believe that these assumptions could become true. And I do believe that in these so far, I do think that General Dynamics is slightly better than these other companies. And then it goes Lockheed Martin and Northrop Grumman. I do think Northrop Grumman is just the worst company we've analyzed so far just because of their slow growth rate and their worst balance sheet. And the final stock that I'm going to be analyzing is RTX. And as we can see here, RTX makes air, missiles, land, precision fires, and maneuvers. They make basically everything, and they actually acquired Raytheon. So this company, as we can see, has Raytheon, Collins Aerospace, and Pratt and Whitney. So they actually have a pretty diverse company because they actually have three smaller companies that they have bought over time, which they are not just one company, and they actually have multiple businesses that make different things in this company. So this is a pretty cool company. But if we go ahead and take a look at their statistics, So if we go ahead and take a look at RTX, we can see that there's a huge discrepancy between the first three companies of General Dynamics, Lockheed Martin, and Northrop Grumman, where they had a PE ratio of about 19 to 20, which is basically in line with the S&P 500. However, with RTX, we can see a trailing PE ratio of 43. So they're right now trading at a double the amount of valuation. You're paying double for the same amount of earnings. But if we take a look at the forward PE ratio, it is much lower than the trailing PE ratio, which shows us that analysts probably do expect this company to start making more net income over time, and which will make up for this valuation. So the trailing PE ratio might be slightly off-putting, but I do think the forward PE ratio shows us a slightly different story. But nonetheless, it still shows a slightly higher valuation when compared to these other companies. So if we take a look at RTX's revenue, we can see that they started off 2010 with about $52 billion in revenue. And as of right now, they're making about $81 billion. So if we compare this to the first three companies, we'll actually see that this company is the biggest revenue maker out of these other companies. I actually do think that they're growing at the slowest rate, however. While they are making the most amount of revenue, their growth rate has been pretty slow. But the one thing I do like, it has also been pretty consistent besides COVID times. So while the revenue growth rate is slow, it is very consistent when compared to some of these other companies. But if we take a look at the net income, let's see if that is very consistent. And as we can see, this is looking not good for RTX. They started off 2010 with 4 billion, and right now they're at 4.6 billion. That is almost not even of 2%. That's like barely any growth in the past few years. This has looked terrible for investors. However, the stock price does show that it has actually been a good investment. But if we can take a look here, the net income has been very, very consistent at basically nothing. So that's not good for us investors. I do not like to see this at all. I would want to see this increasing like some of the other companies we've looked at, but right now it is decreasing. But as you can see here with the shares outstanding, they were buying back shares all the way up until 2020, which they did change the company in which RTX did buy Raytheon and they changed the company how it is. So I'm pretty sure they did this to acquire Raytheon, but I'm not 100% sure. They did this to acquire some other company. So this isn't a huge worry for me. And as we can see, they've actually been buying back shares very fast in the past few years at almost a 10% rate in 2024. So that looks very good for us shareholders. And if we take a look at the total debt to equity ratio for Raytheon, we can see that they're at a 67.8% total debt to equity ratio, which is higher than 50%. So none of these companies so far has had less than a 50% total debt to equity ratio, which is not very good. But if we do take a look at the total cash compared to the total debt, we can see another situation where the ratio is very bad. They have almost $43 billion in total debt, while their total cash is $5 billion. So this is very consistent with these type of companies. They have a lot of debt when compared to their cash, and the total debt to equity ratio doesn't look very good at all. So that's the one thing you need to look at for these companies, that their total debt actually is pretty bad. And if we look at the analyst expectations for the next 5 years, we can see that they're expected to grow at about a 9% rate. And this is in line with the other two companies besides Northrop Grumman. So they're all expected to grow at about a 9 to 10% rate, while Northrop Grumman was expected to grow at only 3%. So there's a reason for that, but I'm not going to be getting into that right now just because this is a basic general overview of these companies in the industry. And finally, for RTX, we're going to be using the intrinsic value calculator to see what price we should be paying for this company. And with the revenue growth rate, I'm going to put this at about I would say a 6% rate. We can see in the past 3 years, they've been increasing at about an 8% rate, and in the past year, about 5%. And analysts do expect them to grow at about a 9% rate, so I think this is pretty reasonable. However, if we look at the net profit margin, we can see that they're a lot lower than the other three companies. So I'm going to put this at about a 5% net profit margin, which is in line with these other averages from the past few years. Finally, for the terminal PE ratio, I'm going to put in a 20 PE ratio like almost all of these other companies. I think that's a pretty reasonable price to pay for these companies. And for the discount rate, I'm going to put a 15% rate. And with this, I actually get a fair value price for RTX at about $46 per share. This so far looks like the most overvalued in the industry. So, me personally, the only company I'm actually interested in is General Dynamics and Lockheed Martin. But I still think all these companies are overvalued. But if I were to look into any of these companies, it would be General Dynamics and Lockheed Martin. But I would need to get a good margin of safety just because these companies have a lot of debt. And I really do not like investing in companies with a lot of debt unless you are paying a very good price for these companies. That is the only way I would see myself buying any of these companies. So, with that being said, if you bought this stock RTX today, I think you would basically be flat in the next 10 years. I could be wrong with this assumption, and also because of their net income decreasing so much, I do think this could be slightly off. I'm not saying you're probably going to make nothing on this company, but I do think you're not going to outperform the market. So, thank you guys for watching this video. If you're here through this entire video, thank you. Hit the subscribe button, hit the like button, and thank you for watching.